Profit is essential for any business, but many struggle to understand what really drives it. While revenue and cost numbers are easy to track, they don't always reveal the full picture. The profit tree is a framework that helps break profitability down into its key parts, so leaders can better identify and improve the factors that impact financial results. This tool, popularized by consulting firms and based on economic principles, visually maps how revenue and costs influence profit. It lets businesses look deeper than basic figures and uncover the real drivers of growth, efficiency, and margin. The simple diagram you see here shows profit splitting into revenue and costs, and further breaking down revenue into price and quantity, and costs into fixed and variable expenses. This is a starting point that can be expanded for more detail as needed. The profit tree provides clear benefits for businesses by turning complex financial details into an easy-to-understand visual format. It helps leaders identify the exact reasons behind profit changes, like whether it's about pricing, sales volume, or costs. This clarity supports better decision-making by highlighting which areas, or levers, will most improve profitability. It also promotes teamwork across departments like finance, operations, marketing, and sales, since everyone uses the same framework to work towards common goals. By using the profit tree, organizations can spot quick improvements and longer-term chances to increase margins. The foundation is the simple profit equation: profit equals revenue minus costs. We then break down revenue into price and quantity. Price is affected by factors like product mix and discounts, while quantity depends on customer behavior such as acquisition and retention. On the cost side, costs are split into fixed costs, like rent and salaries that stay constant, and variable costs, such as materials and shipping, which change with how much you sell. This approach creates a shared language for understanding and improving profitability, whether in high-level strategy meetings or day-to-day operations. Begin by placing profit at the top of the tree, then break it down into revenue and costs, further dividing each into detailed subcomponents. Include influencing factors like customer segments, conversion rates, and churn under relevant branches such as quantity. Use financial data to assign values to each node, which allows for identifying bottlenecks or high-impact areas that need attention. Prioritize actions by focusing on levers that provide the highest return on investment. The profit tree can be created manually on a whiteboard, in Excel, or through visual tools like Lucidchart or Miro. For example, a national retailer used this approach to reveal that although quantity sold was stable, average prices dropped due to excessive discounting and variable costs increased from supply chain issues. By adjusting pricing and supplier contracts, they restored profit margins in 2 quarters. Similarly, a SaaS company facing a growth plateau found rising customer acquisition costs and high churn among small business clients. Shifting focus to mid-market clients and enhancing onboarding led to resumed profit growth in 6 months. These examples highlight how mapping profit drivers systematically can guide effective, data-driven decisions. Fixed costs remained steady, but variable costs increased sharply due to material waste and overtime. While the quantity produced was growing, it wasn't enough to keep up with the rising costs. To address this, the company invested in process automation and lean training, which significantly reduced those variable costs. The profit tree offers several benefits. It provides clear visual insights that make complex financial relationships easier to grasp, helps identify the root causes of profit problems, promotes collaboration across departments, scales to fit businesses of all sizes, and can be customized for different industries and models. However, it does have some limitations. It relies on accurate data, as poor inputs can lead to wrong conclusions. It can oversimplify issues since some profit drivers are interconnected. Building and maintaining it can be time-consuming, and it only shows current conditions without predicting future trends. Plus, it requires thoughtful interpretation to avoid tunnel vision and to consider external factors. Despite these challenges, the profit tree remains a powerful tool for understanding and improving profitability. It transforms profit analysis from a static report into a dynamic tool that breaks down revenue and costs into key drivers, revealing hidden inefficiencies, guiding priority actions, and aligning teams around a shared financial understanding. Whether the goal is to diagnose margin issues, plan growth, or boost operational efficiency, the profit tree provides clarity, structure, and insight, empowering leaders to make smarter, faster, and better informed decisions.